Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Monday, April 29th, and we have Brent crude oil trading at 88.67. A drop this morning in early Asian trade of about 1%. We got WTI at $83.12. Let's kick off, as always, on Monday morning with Omar Najia, Global Head of Derivatives at BB Energy. Omar, it looks like the market's run out of steam a little bit. Consolidating $90 a ceiling or a floor? Your thoughts on where we go from here?
Floor, we go higher. So basically, we've had a rally since the beginning of the year, and I think basically that rally continues. That rally is not just for oil, it's basically for equities as well, it's for risk assets as well, it's for commodities in general as well. Look at the price of gold, the price of cocoa, the price of copper. So the question is, what could possibly push prices of everything up? So, one way to view it is too much liquidity. So I can't tell you what's pushing copper up. I can't tell you what's pushing gold up. I can't tell you what's pushing Bitcoin up. I can't tell you what's pushing oil up. And I can't tell you what's pushing cocoa prices up or the S&P. But I can tell you one thing that pushes all of them up, and that's higher inflation, higher liquidity, right? Money chasing places that it needs to go. So my thesis, my theory, my whatever it is we are going to keep seeing higher prices. Some people will call it stagflation now. You've seen headlines on Bloomberg, stagflation. Well, I don't know if it's going to be stagflation, but I certainly know it's going to be inflation. The US cannot keep increasing its debt at the rate it's going. It cannot. Something will give. And there is no solution to increasing your debt because no politician can come and say, we're going to cut spending. We're going to cut spending on defense. We're going to cut healthcare. We're going to cut entitlements. We're going to cut. Nobody's going to do that. They're going to keep borrowing and spending. And the Fed is going to cut interest rates this year because Treasury needs to borrow money. And the Fed cannot afford to pay interest on debt it already has, let alone on what they're going to issue. So I think basically prices of everything are going to head higher. Doesn't mean that today it's going to go, $10 up or next week or what, but I think that's the trajectory, higher for everything.
Brian Pieri, founding member of Energy Rogue. Brian, do you concur? Will America's stomach tolerate continued inflation as the Fed cuts rates, as Omar says they have to do?
I actually agree that that debt is a problem. It's not only a government problem, it's a consumer-based problem, and I think it's getting tighter. People are getting backed into a corner. So the government, as well as consumer base in the United States, has really backed themselves into a corner, and that makes it harder to navigate out. And the easiest way to do that is to print more dollar bills. And as a matter of fact, before we started recording today, Andy, Omar, and myself were just talking about the fact that it's interesting when you look at it because then I look at headlines about the strong dollar. And well, what is the value of a dollar? It's the value of the dollar is really relative to what you're going to purchase with it. I mean, what is it? What is a dollar worth? Well, it's a piece of
Worth
paper.
over 150 yen.
Right.
Or
It's
160, I should say, 160. I mean,
I
it's really
mean,
extraordinary.
ever since we went off the gold standard, it really is just a piece of paper, and the value is really what somebody else believes it's worth. And whether you're trading yen, whether you're trading crude oil, whether you're trading natural gas or whatever, it's really what the opinion is. And as a matter of fact, in the great in when we had the big real estate bust in 2008, 9, that time frame, I made a comment. I was working on a trade floor, and I made a comment that, you know what? I think the market dropped 40%, and I said I think we should drop another 40%. because what is the value? What is the value of the dollar? So I do think Omar is right on target, is that the Fed Reserve as well as the government has really backed themselves into a corner, and the easiest button to get out of it is to print more dollars, which means more inflation to come. And we're kind of in this cycle. But when we talk about how this impacts oil prices, it it gets a little complicated because then you get into the geopolitics of what is happening out there. And I think everybody's a little tone deaf to some of the geopolitical risk that's out there. I mean, we had attacks on Israel, attacks on Iran, and it seemed outside of a span of a few hours, it really didn't result in anything. So I think there's going to be interesting times to come. That's for sure.
Andy Critchlow, head of news EMEA for S&P Global Commodity Insights. Andy, what do you think sort of defines the next sort of trend direction of prices in the second half of the year? We saw in March that the breakout of the sort of Brent high 70s, low 80s in up to the range we're now in, high 80s, low 90s briefly, but ultimately we broke out of that range. Seems to be more on the back of OPEC announcing that it was extending its cuts through to the second quarter rather than the geopolitical noise. Your thoughts on that, and what would break it out higher or lower in the second half of the year?
It's a good question, and you're absolutely right about OPEC holding back its production for longer. I think the story is really about supply, and we don't talk enough about that. The market tends to focus more on demand post-COVID. This expectation that economies are just going to keep going higher and higher. People keep borrowing, spending, etc. But actually, the real thing capping the market at the moment, and I do mean capping it, is supply. May 1st, we have the opening supposedly of the expanded Trans Mountain Pipeline in Canada. That's going to add another 300,000 plus barrels of Alberta oil sands to the West Coast. So that pipeline goes to almost 900,000 barrels a day capacity. You're going to have that extra 300,000 barrels that's going into that's going to go into the Pacific Basin. That's going to go to Asia. That's going to have a massive impact on this market share battle, which is already starting to percolate within OPEC between Russia and some of the OPEC plus countries for these markets in China, supplying heavier crude grades into China and other Pacific Basin countries. And that's off the back of a 2023 where we saw record US production, US producing over 13 million barrels a day of crude, upwards of 20 million barrels a day total liquids. We had a lot of M&A activity in the US shale basins at the end of last year. These big IOCs that bought those companies, they're not going to sit on the assets. They're going to want them to pump more. So the expectation that America can keep on pumping more while OPEC holds back. OPEC's now at its look, it cannot cut anymore. It really can't. And you look at the pressure that the Saudis are now putting on countries.
But could it roll over its cuts through to the end of the year, this 2.2 voluntary cuts that's basically in the hands of a few countries, most notably Saudi?
Yeah, it's a good question, because even in Saudi Arabia, they're struggling. You've had Mohammed bin Salman. He's had to take a punch on the nose, cut his really ambitious NEOM real estate project. Many people saw that as a kind of barometer for where Saudi sees the oil price. It's now a fraction of what it was meant to be. One of these huge real estate projects has been virtually cut in half. That's all to do with the oil price. So how long can Saudi sustain holding back huge volumes of its own production? It certainly can't ask any other members within OPEC to do that for much longer. So for me, it's all about supply, and I just see more oil coming online. And do I necessarily see the demand to match that at the moment? I think it's hard to say.
Omar, just picking up on your earlier comments there, there's three things that seem to can't coexist: print more money, inflation, and rates staying at 5% or whatever staying where they are at the moment, if you like, i.e. no cuts this year. I mean, the Fed is signaling increasingly. I mean, we started the year with 7 cuts expected. We haven't had any yet. Markets saying the soonest is fourth quarter. I mean, and that's right into the election window. Where do you see the cuts coming, the Fed cuts? If you're forecasting continued printing of money, tolerating inflation, when do the Fed's cuts come? And if they don't come in the second half, how does that impact your sort of direction of travel, if you like?
Okay, so Fed cuts are coming, and the reason why they're coming is to do with the debt that they need to basically issue, not to do with the Fed. So inflation is going higher, but the Fed.
So basically, you're saying that they will abandon their mandate, which is employment and inflation, and tackle something else.
Okay. So if you believe that basically the Fed follows its mandate and is not political and does things because it's looking after the U.S. economy and all that kind of stuff, then my answer is not going to please you. So I don't believe that in the slightest. Okay, the Fed does. What the Fed is trying to do is keep the economy going, right? It's trying to. It's like an analogy is like a drug addict of the US economy addicted to debt. And the only thing that will do is basically either it goes cold turkey, in which case it's going to have a really bad time, which is not good politically, or you give it more and more drugs. So the Fed is basically like the drug pusher in charge, basically. So the problem that the US has is it needs to borrow money, and it cannot afford to pay debt, interest on debt, at even now at 5%. So what it needs to do, what the Fed's going to do is decrease interest rates to allow the Treasury to go in the market and basically sell more treasuries and get more money, et cetera, and on we go, and more debt and greater piles of debt and greater piles of interest on that debt. Now, to do with basically oil markets and physical and 300,000 barrels and OPEC and all this kind of stuff, again, extremely interesting, but these markets they do not trade according to physical flows. What we have to understand is that now there is a new strategy. There is the West and there is BRICS, and BRICS have a strategy. It's not like they're going whistling and they're going to fight each other. No. There is a strategy. There is a strategy going forward of the BRICS being together, of Russia and China being not just allies, but doing anything for each other. And the idea is to hamstring and bring down the US. It's that simple. So will Russia sell more oil to China? Will China give them preferential treatment? 1,000%. Will the Indians listen to the US? No. Will they be really friendly with the Russians? 100%, right? So this is what we fail to understand. The world has changed completely.
I mean, while all those things might have elements of truth with them, Brian, bring you in. We still have a market underpinned. I mean, by 6 million barrels of idle supply. At the end of the day, Brent crude oil is trading close to $90. Because 6+ million barrels of capacity is shut in. You open that, and for whatever amount of liquidity and inflation and printing of debt, and oil prices are $50.
Yeah, I mean, one of the things that we look at really closely is with the growth of the U.S. supply over the last 5 years. It is that it's been an accelerating engine. But the problem is we produce 13.1 million barrels a day in the United States, but we decline every single month 640,000 barrels. So unless we bring on new barrels every single month, it's not
which most oil companies do, right? I mean, that's not they
do, but that engine is slowing down. And that's part of the reason that when I say 13.1 million barrels a day, if you look back to October levels, what did we produce? 13.1 million barrels a day. We've flatlined. Most of the oil analysts coming into this year have been expecting another million barrels a day coming out of the U.S. And we've been saying, nope, You're not going to see, you may even see decline. So the one thing
And the
that,
reason for that,
and the reason
ultimately,
for that is because in the United States, in the shale basin, when you bring on a well, such as in the Permian Basin, the first month it produces 1,300 barrels a day, one well. It produces 1,300 barrels a day. A year later, that same well produces 200 barrels a day. So the thing is that it's a hamster wheel. So we have such new reserves and new production that we are on a treadmill, and that treadmill has accelerated. And as it's accelerated, you've got to keep this engine going. And then you throw in complications and challenges such as interest rates, inflations, and costs. And one of the things that I see is, yes, we have 6 million barrels a day of idle capacity, but at the rate that the United States declines, if we don't replace that, which we currently are, but if the United States falters on that, we're going to need that capacity because long-term investments are not happening in the oil space. You can look at some of the large-scale investments offshore in the United States as well as internationally, and these large-scale projects, as emerging economies are growing, they need fossil fuels, they need oil, they need natural gas, and honestly, in a few years, I think we're going to be surprised at what oil prices really are.
$50.
I see Omar likes that.
Well, I think we've all been quite surprised that oil prices have stayed so low for so long, and somehow they always seem to, they could buy you five cappuccinos 10 years ago. They can still buy you 5 cappuccinos for a barrel
right.
of oil. Andy, a strange thing happened over the weekend. We had the UAE and Saudi oil energy ministers on stage, and essentially two of the biggest players in OPEC, and not one OPEC headline. They were all talking about the UAE possibly tripling its renewable energy capacity and so forth. This was a World Economic Forum event in Riyadh. Your thoughts on that? Or maybe I missed them, but nonetheless, very little to no OPEC oil news coming out of Riyadh on a day when you've got two major oil/energy ministers.
I think that there was a lot of important discussion going on in Riyadh about oil, though, and that probably gives the game away that they didn't want to talk about it. There were no headlines. You had the OPEC Secretary General, you had Sahel al-Masri and obviously the Saudi oil minister all in one place at the same time. Along with the CEOs of Exxon, Total, and Oxy. I'm sure oil was very much on the agenda off the conference floor. OPEC's big problem is it's got nowhere to go. They've got a May governors meeting coming up, and then they go into their full meeting in June. Expectation is probably that they're going to roll over these cuts again. I think that your point about 6 million barrels a day of idle capacity at the moment on the sidelines, certainly the market doesn't need more oil at the moment. From looking at prices, we're fluctuating high 80s to low 90s at the moment. It doesn't really seem to be going any higher. Of course, these thresholds are a long way below fiscal break-evens for the Gulf producers. Abu Dhabi cannot run itself on $80 oil. Saudi Arabia certainly cannot run itself on $80 oil. Although the fiscal balances in these countries are healthy at the moment and not being drained. To grow, you need $100 oil in the Gulf, and you can see that just by the amount of capital spending on the ground, just by the need to invest more foreign reserves overseas through sovereign wealth funds. So they've got nowhere to go. The big question again is market share. They're having to put a huge amount of pressure on some of the peripheral producers. I mean, we say peripheral producers, countries like Iraq, which is the third largest producer in OPEC now. Iraq is under massive pressure to meet its quotas. According to our secondary survey, it has been over quota significantly for a number of months. And that's even with the KRG not able to officially export oil via the pipeline to Ceyhan. Is that oil being smuggled? It's a very difficult story to pin down.
And would that quote unquote, if you're saying there might be smuggled oil coming out of Kurdistan, would that be counted in the Iraq numbers, or is that under the radar?
Well, this is a huge issue of contention within OPEC. How do you account for KRG barrels at the moment? Certainly, from the Iraqi perspective, the federal government perspective, those barrels, they would not want to surrender them if the pipeline was reopened. But at the moment, there is a big gulf between what Iraq officially would report as its official production numbers to the OPEC Secretariat and what secondary sources see on the market. And that's obviously gained through reporting market sources and, direct contact with the KRG. So, when you have major producers arguing over, fairly marginal amounts of barrels here, you can see how the market's strained. And then on the other side of this, you have Gulf producers now increasingly blending condensates into their own crude pools. Of course, condensate isn't counted as far as OPEC production is concerned. You've had a lot more wet gas production in the Gulf recently. Some of that to go into LNG, some of it to meet domestic demand. Whenever you get that, you get a lot more condensate. You blend it in, and we've reported at S&P Global Commodity Insights, countries like Oman, their crude grade is getting lighter because they're having to blend more condensate into it.
Let's go to the survey question, which sort of tackles some of the themes we were discussing. What will have biggest determination on the direction of oil prices in the second half of the year? The Ukraine war, Mideast geopolitics, OPEC cuts being rolled over into the second half, or no Fed cuts in the second half? What will have the biggest determination on the direction of oil prices in the second half of this year? Pick your choices there. OPEC cuts roll over, or Mideast geopolitics. There's a lot of talk today, at least reporting that the oil price is falling today because the signals that there could be a ceasefire between the different actors in the Gaza crisis. Omar, coming back to the thesis of those sort of points in that question and also the points you made earlier, ultimately, the cutting cycle of the cost of money, which is, of course, not just the Fed, but most monetary policy makers, central bankers in Europe as well. From your point of view and strategy, does it really matter when that sort of shoe drops, if it's the second half of the year, if it's next year? Ultimately, the trend continues to be, according to most market forecasts, that the next cycle is cutting one on monetary policy across the world, particularly the OECD countries. Does it matter when that starts from your perspective?
When the cutting starts?
Yeah, the price of money becomes cheaper.
We tend to think in extremely simple terms, right? So debt is massive. Interest rates are at 5%. Inflation, last report last week, is growing, expected at 2%, came in at 3 plus or minus, right? So think in kind of simple terms. You have a geopolitical situation which is both in Ukraine and in the Middle East, which is basically do or die. The idea that people sit and hug and whatever, forget it. This is do or die. So you have that. You have an inflationary environment, right? And with all that, you thinking, yes, oil prices, I might as well be short because what's going to happen. Nobody's going to invest and, we're going to dump. So I better be short. So that is not, we like simple things. We like inflation's up, geopolitical is dangerous, and nobody's investing in oil. Should we buy or should we sell? No, we're going to buy, right? It's as simple as that. OPEC Plus will continue doing what's best for OPEC Plus. The BRICS will continue doing what's best for BRICS. The EIA will continue saying that oil prices are going to fall. The Fed, Biden is desperate to push oil prices lower, absolutely desperate. The SPR in the States, non-existent. And with all that, we're going to say, yes, I think, we're going to get to 50, maybe 40, maybe $10 oil. And, here we go. And we better sell it. Meanwhile, the S&P is setting record highs. Gold is, all-time highs. Bitcoin, all-time highs. But you know what? I'm going to sell oil because, OPEC are not going to agree. So no, that's not simple for us. That's deluded kind of thinking.
Brian, speaking of deluded thinking, the US majors bought a number of major shale oil producers last year, and a year in which obviously prices were up and the production in the Permian was substantial in terms of its increase. This year, as you have predicted and predicted early and ahead of most, that indeed the output increase in the US would be fairly sedate this year, and that's certainly proving to be the case up to now. Is there an interconnection between those two events? The fact that the big majors have come in, taken control of the Permian, and now production has been sort of not growing anymore, at least for now, or are they totally unrelated?
Well, I think there is a relation. It's probably not direct. When it goes, I spent some time within Chevron, and actually several upstream companies. And when you look at owning Permian or Marcellus Utica or different basins in the United States, it becomes an investment on what is the best return. Let's take Chevron. So Chevron buys some Permian. Well, they still have a very good play down in Venezuela, and that license is not impacted by the recent moves. And so then it's, well, what is going to be my best return? Is it going to be in Venezuela or is it going to be in the Permian? And then they allocate that capital to what the best return is going to be. And as these majors, and especially the integrated majors, they might have a better return on the refining side of the equation. So it's not just an upstream side of the equation. When you look at ExxonMobil, when you look at Chevron, they have refineries, they have downstream, so it becomes an efficiency of which one. Now, part of the reason that we've had so much growth in the United States is you've had so much private equity driving a lot of the decisions on pure plays within single basins. So their only choice was either drill or don't. And so then they built up a portfolio of a single basin asset, and they were really priming it for sale to the majors. Now it's going to get into an efficient development over a long period of time. And quite honestly, it's going to be it's going to be better managed for oil and gas reserves to be in the hands of the majors. But I'd say there is a connection. It's probably interrelated, but not direct, if that answers your question.
Yeah, Andy, just picking up on that, the U.S. majors and they're managing their strategies. But we've had in recent weeks now the two big European oil majors, Shell and Total, and Total as recently as Friday saying about the moving their listing to New York rather than being listed in Europe. And is that would that be significant? It's sort of been mumbled about for a number of years now. I'm not sure why now is any different, or is it? And is it would it be significant development?
Well, of course, it'd be a significant development for stock exchanges in Europe. I mean, you've seen this with, the FTSE and the loss of some of the mining companies, which delisted their London shares, moved back to Australia. Would the same happen with, some of the UK IOCs? I mean, it's more of a capital markets issue. Does it affect operations? No, not at all.
Well, it might affect operations in the sense that listed in the US, you might be encouraged to drill, whereas in Europe, you might not be as much.
Well, you might be encouraged to drill, or you might be encouraged to buy. You could make the argument that the regulatory environment for M&A is more conducive in the US. And of course, we had Reuters last month reporting that Abu Dhabi had reviewed BP as a potential acquisition. Of course, that is a story which has existed for many years. I reported.
Well, maybe with a higher share price and a higher valuation, you would be able to buy.
Well, of course, and a large M&A historically happens at the top of the market, and we've just seen that copper hitting $10,000 a ton, and BHP Billiton making a play for Anglo American to get hold of its copper assets. What does that say? It certainly plays into your $50 a barrel narrative, perhaps. Are all these things happening at the top of the market? But I think it's about regulation, and of course, the idea of a mega merger happening within the European IOC space is very difficult. Although the economics of that makes sense, the regulatory hurdles in Europe are much greater than they would face in the US. So how much of this is around that and the likes of Shell, the likes of Total, the likes of the other IOCs putting pressure on European regulators to say, look, let us do what we want. We need to make deals. We can't necessarily find the greenfield investments. There aren't these major oil field investments for these IOCs to get the terms that they want anymore. So how do you expand your revenue base? You've got to go out and be inorganic, and you've got to go and buy it.
And go list in New York. So what will have the biggest determination direction of oil prices in the second half? OPEC cuts roll over for the rest of the year. And ultimately, just on clarification, the point I made regarding $50 is that if OPEC Plus wasn't cutting 6 million barrels of oil a day, that would be, or if they were to stop doing so, inevitably that would send prices down.
John, you look really smart if it does happen.
Well, I never rule anything out, but that one seems like the most unlikely of all of them. I think it is an important dynamic in the sense that all of the reasons with liquidity and inflation and so forth, which has been around 10 years now, has lifted the price. But the 6 million barrel idle sort of keeps pulling the price back, even though Bitcoin and everybody else is going to the moon. Oil is being left behind because, well, there's 6 million barrels of idle capacity. So it acts as a drag. Anyway, that's where we are. Brian Pieri in Denver, thank you so much. Andy Critchlow in London, and Omar Najia, the genius of Monday morning. Thank you so much, as always. Have a great day and week, everybody. We're here every morning at 10:30 UAE time. All the best. Thank you.
Thank you.
Thank you. Thank you.